Welcome back, everybody. I am traveling this week. I've been in New York City, messing around, having fun, recording short interviews, and I'm glad to be, glad to be up here. Weather is much nicer, a little bit cooler than Florida most of the time, so it's been fun. Hopefully, we have a lot to talk about today. I want to remind everyone to request if you want to speak and keep your responses to about 1 minute if possible. And if I boot you off because you're talking too long, then I'll put you back up. After 3 minutes in the penalty box. No, 2 minutes in the penalty box. So, anyways, we have a lot to discuss. We can. I was on Neil's last week, and whenever I'm on these podcasts, I get a bit excited, and I don't choose my words very carefully. So I think I said some things that I didn't really, didn't come out the way I wanted them to. So I'll clarify all that, especially diversification. Obviously I'm a big fan of diversification, but there's limits. Yes, we have to cut that diversification off after a while and focus on other things, of course. So anyways, without further ado, I'm going to invite people up and take off and get us going.
Hi to everyone. I'm very happy to be here. Today I'm in one of the best places for me in the world, on the Black Sea coast, near Novorossiysk, Krasnodar region. And I love this place from my childhood, and I decided to be here and had a nice swim in the sea maybe 20 minutes ago. And I decided to be here today because I love this conference and I love this place, and so I decided to be here.
G'day, Jerry. G'day, everyone. Good to be here. Jerry, I loved your podcast with Niels last week. In particular, your comments regarding diversification. I totally appreciated where you came from, but I thought this would give you an opportunity to address some of what you might have thought that you restated incorrectly. I thought it was great, but please give us your ideas about how you'd address some of the things you said.
Right. So, I was just explaining to Niels, that I had let creep into my strategy that I would trade about 15 markets a bit bigger because they are not really correlated to anything else. The cotton, coffee, cocoa, sugar, juice, palladium, emissions, maybe rubber, iron ore, things like that I had sort of decided that I was going to trade a bit bigger than everything else. The 185 other markets, I would trade them all the same size. And I know that Niels had commented that he didn't like that idea. But, I really am getting motivated when I hear the right reason. And so I didn't ever really think of the right reason not to do that until, once again, Richard was talking to us about hunting outliers. So I was like, oh yeah, I still have that part of my system that pays some attention to, I shouldn't have said diversification. I should have said smoothness. And we all have these issues that it's just a given that diversification, which is going to yield some sort of smoothness and some sort of lack of bumpiness, is going to be something that everyone is going to desire. And so as I do desire diversification, because I trade more markets than almost anybody, in anyone in the CTA land, not everyone, but most everybody, it's for hunting the outliers and not for smoothness. So there's no reason to put anything in your portfolio that is going to pay homage to I want a more smooth return. However, I will say that I am not going to trade all stocks, or I'm not going to not have meaningful positions in 15 or 20% of my portfolio. Let's say I'll have in the bond markets or currencies, obviously more in commodities and stocks, I guess primarily because there are more of them. There are more stocks, and then there's more commodities. And then I guess in third place would be the currencies. And in last place, because there's not that many of them, although I do trade a lot of interest rates. So I'm not going to, on purpose, torpedo my portfolio and get it to too one-sided, unjustifiably. So it sounds like a very discretionary way of looking at it, and for me right now, it kind of is. I'll probably know if I'm 80% stocks, that's too much. 20% is not enough, but I'm kind of in the middle of planning on increasing my stock exposure to, 40 to 50%. Just because there's more markets and they're different, and even though they all will be correlated sometimes, for the vast majority of the time, they're doing their own thing. And I'm overlaying all of these positions with trend following, so it's not nearly the problem that one would have with correlation and diversification if it was just a long only subjective way of determining which positions you're going to be in. We're trading systematic approach where we're going to go with the trends, exit those trends, maybe even go short. So it adds another a layer of diversification. So I'm not going to worry so much about the lack of smoothness. That's what I should have said. I had a word in my head and I can't think of it now, and I couldn't find it. But I wanted to throw that word in, and so in order to throw it in and shock Niels, I'm all about shocking him and I mean most anyone actually. So I really enjoy getting Niels all fired up with my shocking subjects that I want to talk about, and get him all excited with these extreme ways of saying things, so that I can have fun with him. But yeah, so diversification, unlike most other strategies, should be we value it very highly, but it's mainly there for us to be able to trade small, make small bets, and scour the world for as many outliers as possible. I hope that's fair.
I think I was a little maybe surprised when I was hearing this, but I'm maybe a little bit an expert in choosing the markets because of my limited deposit, and so I fully agree that these 15 markets and commodities markets in general are the most diversified and uncorrelated sector. And if we trade, say, 200 markets, I think it's a good decision. It's a good decision if it's a row, of course, and of course it's a row in your case. I think it's good. Because I thought a lot about what market must I choose to be to trade in a more effective way in a situation where my deposit isn't big enough to trade all the markets. So I think it's a very interesting decision. I think so.
Yeah, so I see it as this. I think that ideally, as classic trend followers, we want to get the most uncorrelated portfolio we can get our hands on to catch these outliers. In other words, the more uncorrelated all of our return streams are, the more chance we have of wide exposure to catch an outlier wherever it exists across the financial market, so across asset classes. If, for instance, we had too heavy an exposure in equities, effectively we've got an infinite possibility of diversification across asset classes. So there comes a point in time where we've got to say, do we sort of have a balanced representation across asset classes, or do we invest heavily in a single asset class? And I'd say from the position of trying to catch these outliers, we want to spread our bets over asset classes. Because we're not only getting the outliers associated with an individual market, we're also getting outliers associated with we want to basically get a diversified spread of outliers throughout our time series. So in other words, if we've got a 20-year track record, we would like to see our outliers being located or distributed evenly throughout that entire track record. But that's not how outliers typically come. They typically tend to cluster in zones over that 20-year track record. But the more we invest in uncorrelated markets, the more we get a spread out distribution of outliers as opposed to a concentrated focus on outliers in a particular time period. Now, what that therefore does is it means that we get the benefits of compounding because the outliers are distributed across the time series rather than concentrated at locales within the time series, where the periods between outliers, we can get these large drawdowns, which we don't like. No one likes them. But the more we get the outliers distributed across our portfolio, the less the drawdown impact, which we're after. So it's interesting because with these classic trend following models, we've got the luxury, unlike other trading models, of not being we don't require as much attention on correlation because the method we have to reduce the risk from our portfolios is through our stops and trailing stops. Other models or other trading models that don't have those risk mitigation measures, they need to treat correlations much more seriously, and therefore they're much more focused on the historical correlations that exist between markets because they're using that as a risk mitigation mechanism. The same as volatility targeting. They're using that for risk mitigation. They're using history as a basis to make that assessment. We're saying, well, we don't need that because we've already got our risk mitigation measures, which are our stops, our trailing stops, and our small bet size. So therefore, our attention can be focused on a bigger pursuit, how to get the best sequence of outliers we can in our return stream. And I think that's what we're talking about here.
And I want to say that I think that if we are talking about different asset classes, about sectors, we can see, and we always maybe talk about this, that in financials we can see a very big correlation, and of course we must not pay too much attention classical trend following on correlation because it changes from time to time, but stocks, bonds, and currencies, at least in my view, is a very high correlated sectors. And commodities is the least correlated sector, and in fact, it is least correlated sector. So, I think that it's interesting to trade commodities bigger twice, maybe in this way of thinking, because we see in the history, every time when we say crisis, we see how bonds, stocks, and currencies, bonds and stocks, they go to one, and currencies also, I think. But commodities do different things. Maybe we can see some level of correlation in commodities also, but not so. It's like Neil said, it's the most stability we see in these sectors. In all crises we have faced it. So I think it's interesting decision. It's interesting decision to take them a bit larger.
Yeah, I mean, this is interesting, and obviously I kind of agree with what Rich said. However, and I don't necessarily agree that commodities are the best, least correlated sector. I mean, this is a particularly interesting time where we're short every currency. I mean, except the peso. I'm long peso and maybe Brazil. I think Brazil. And I trade a lot of the cross rates as well. But so there's no diversification there. Short every bond market, every bond ETF that's possibly to be traded. No diversification there. For the past 8 weeks or 9 weeks, we've been getting crushed in the commodities. They're all going down, just one after the other. Started with I'm guessing base metals. It's bled over into grain devastation, and now energy. So, there's a bit of diversification in the commodities. They certainly, during periods of disinflation, uh, acted very similar. The poor performance was across the board um, during the Fed this recent past 10 years. So all of a sudden, though, we wake up and the only diversification I'm getting now is I'm long about the same amount of stocks as I am short. So, um, and this can happen. And then, of course, I've mentioned many times that we've all lived through it. And I've complained more than almost anyone about stocks all going down at one time. And but back during COVID, and as I've said many times, January, February, COVID, it wasn't just the stocks went to one, everything went to one. All the longs went to one. They all went down. Currencies, commodities, stocks, and bonds. So this brings in the one of the most important points for any trader is the initial choice of leverage, the initial choice of your risk budget. And so that needs to be very conservative because you are going to run into these periods where you're going to be very unhappy because you're losing money in everything. You can't turn it around quick enough to get out of your longs that are retracing or get short. This is a very bad period of the COVID. So anyways, it's like no perfect answer. And then, so I would say that the sector approach, I agree with what Rich was saying in general, but some of these outliers come from a sector, and the outliers have much different performance than the rest of the sector. See, there's the dilemma. We're back to the same thing we talk about all the time. We're going to trade crude, Brent, heating oil, unleaded, and gas oil. And we're going to trade platinum, gold, and silver as if they're not all correlated. And copper, aluminum, nickel, lead, and zinc as if they're not correlated. Because within that sector or micro sector, yes, we're going to be concerned when they all go up and they all go down. But the whole game plan is we're not going to be surprised, and we're setting up the portfolio and the strategy to say, hey, every now and then there's going to be zinc only. That's happened. I've seen that. I've made money on that. Heating oil only. Moderna and Tesla. Okay, so the other ones may have gone up during that period of time, but nothing like Moderna and Tesla. So there you have it. That's the sort of the problem, is that on one hand, we do understand all the things that have been said, yet these outliers are hidden inside these sectors or groups, and all of a sudden spring to life and make have a big outlier that is not, we don't see anywhere else. One of the things that happens with CTAs, I remember Mark talking about this months ago, and I was like dumbfounded by it. But for the typical CTA that Vol manages and manages correlations as well, it is all about the sector moves because they eliminate the big outlier. They talk about staying in the outlier. So I still have a position in this outlier, but I have materially cut it back because of correlation and or volatility. But they're not making the outlier money. And so they're not playing for this outlier. Correlation matters. Diversification matters. They're making money when the whole currency sector moves or the whole bond market moves, and as are we sometimes. But I have a tendency to give a lot of that sector move back in the bonds, or I would do that in the currencies. But we also have a tendency that if you're hunting outliers, you're going to get that 100 to 500 ATR move that comes from one or two of those commodities. Not, it's much different than playing just for that sector move.
Yes, but I want to say that I look, of course, at commodity. Maybe I'm not right in this, and I look at equities and bonds as a sector, equities as a sector, FX as a sector, and of course, because of that, I look at commodities sector as a sector also in my trading activity. But maybe there is a few exception in this mindset because for me personally it isn't. It's more correlated, more uncorrelated than. As I have said before today, it's more uncorrelated. Of course, it's a sector, but we can see if we trade, for example, 15 commodities, we can see different moves in different direction. We can see this. I think it's more uncorrelated than stocks. It's my opinion personally. Maybe I'm not right, but I think so.
Hi guys. Hey Jerry, hey Rich, hey Oleg, hey everyone else. On the, as you know, I'm trading a trend following system on the short end. So this week is particularly so this is one of those weeks that it is negative for me. So that's probably not surprising. So that's point number one. Point number two is I'm keeping a close eye on the weeks of the weeks, just to see how the market, whether the market is volatile or not. Weeks keeps the volatility of the S&P 500, and weeks of the weeks keeps the volatility of the VIX itself, and when it is less than 90, which at the moment it is, so it's just a good indication of the things are not very volatile at the moment, and things are not moving basically. And in terms of the correlation calculation, when of course Richard specifically mentions those his views on the correlation calculations, and Oleg and Jerry. So there is a slight, so we have that difference of the volume between if you're just trading long term versus if you're trading a long and a short term system. In a short term world, you trade thousands of trades, and the correlation is for me the most important filter. And across the board, usually people hire PhDs to be able to create a certain edge on those correlation calculations, basically. And so in terms of the correlation, so I calculate my correlations on the fly. I always calculate correlations on the entire portfolio, and trade the instruments that are not correlated based on that definition of a correlation. Okay. And also there is, while trading fast and short term, also you need to calculate correlation from your orders as well. So that's also something else possibly is not bothering you if you're trading long term. So let's say that you would want to trade a portfolio of 20 instruments, and 10 positions are open, and 10 positions are at the moment standing as order. So you would want to calculate correlation from both your orders and the existing portfolio to ensure that once those orders are executed, they are also going to be uncorrelated. So that's the update on my end. Thank you.
That's very interesting. Thanks for that, trading mentor. Look, just in relation to correlations. So, as trend followers, we don't mind it when we're trading positively correlated markets in our favour. In other words, if it's beneficial to us, and we've got multiple trades on different positively correlated markets, and they're all going up, that gives us a windfall. Potentially, we can get, a non-linear windfall, as we have so many, big magnitude moves of highly correlated markets, and we're all trading in the correct direction to them, so we can clean up. So in 2008, 2009, that's exactly what was achieved by trend followers. We got these massive returns during that very correlated period where we were trading the correct direction of equities, and it was all going south, and everyone did really well. Now, where we don't like correlation is when it's adverse to our directional position. But we have these stops, we have these trailing stops, which is our form of risk mitigation that says, all right, we can tolerate a degree of positive correlation, but we know that we're going to get out of these trades when it hits our stops or trailing stops. And yes, we can get a situation where a large portion of our portfolio is all sort of positively correlated and going the wrong way. So when you add up those linear sort of losses, we can get a non-linear event from the combination of being too positively correlated. But when Jerry was talking, I was thinking to myself, well, we do have a technique, for instance, to break the correlation that exists in a market. So with equities, we noticed that during periods of crisis, all of the equities turn south. But there is a mechanism that we can use to break that correlation of the market relationship by trading spread trades. In other words, we might go long a company that sells snowshoes, and we might go short at the same time a company that sells surfboards. Now, we trade that as a spread trade, and so we know that they're both uncorrelated to each other. Snowshoes, surfboards, they're uncorrelated. We have an equal weighted position long and an equal weighted position short, and lo and behold, we break the structural correlation that exists in the market, and we're trading the relationship between the outliers that exist in the individual businesses as opposed to the sector. I think that's something we should explore further with classic trend following, because I think classic trend following is looking for these outliers. We are less concerned with correlation, or we'd like to eliminate impacts of correlation in our portfolio so we could focus specifically on the ability of a return stream to deliver an outlier. And that makes me think maybe we should look at it in sort of more theoretical terms and look at these sort of possibilities, looking at unusual sort of spread relationships with trades and getting our outliers that way. What do you think?
Well, I mean, I don't think it needs to be quite that difficult. And we talked about spread trading last week, and that's very problematic to integrate spread trading into a system if we abide by the system rules. But anyways, I think though you hit on it. You know, it's kind of like a traditional manager. The rest of the 99% of the world, they are going to always suffer from high correlation in these stocks. And yet with us, if we go to one, I'll lose money on my longs and make money on my shorts. Just outright trend following the same, those markets and getting short signals. So now that's the key, isn't it? So do you have, are you long all of your stocks? Are you short all of your stocks? Back in the COVID period, we were long everything, not just stocks. This period since COVID, it's been amazingly longs and shorts, fair amount of longs and a fair amount of shorts. Now, with this rally in the market over the past few weeks, I see 50 new 6 months highs every day and 3 6-month lows every day. But it doesn't mean that those shorts are ready to be liquidated and everything go long. So that's sort of the key, is in this balanced portfolio of diversification, do you have some longs and shorts? Overall, do you have longs and shorts within the sectors? No, not in currencies, not in bonds, not really in commodities. I have my favorite cocoa short in commodities, but stocks, yes. So all of a sudden, this vilified sector that can go to one is the only place we're getting some meaningful diversification as it relates to longs and shorts. And that's our goal as a setting up. And as you've heard me say, people ask me this same question over and over. How do you choose these stocks? And my initial answer would be the same way I choose the commodities and the currencies and the bonds, and that is I try to trade liquid instruments that give me a fair amount of diversification. So much easier to do in the stocks, because in the commodities and the currencies and the bonds, every CTA trades them all without regard to correlation almost. And they may have some correlation strategies that where they'll add and subtract. But we like to trade all of these markets. But in the stocks, we really have a choice, which is daunting and makes most people shy away from that choice. I don't know what to do. What do I do? There's 5,000 stocks. I'll just trade the indices. So that's what a cop out and what an abandonment of some amazing diversification. I used to think that I used to hate that term managed futures, and I used to always replace it with CTA trend following because I just despise managed futures as a term. But now I've embraced it because what most of the CTAs do with the vol management, their correlation management, their desire for smoothness, and their disregard for making hunting outliers the bottom line, that's managed futures. That's great. So I don't even know if we need to say classic trend following anymore. I think just trend following versus managed futures. Oh, indexes as well. You can't trade single stocks and be in good standing in the managed futures business. So they've really given me a really good foil where what I do is hunt the world over for hundreds and hundreds of markets to trade, exploiting those markets with the trend following, and certainly want to get out of being called anything to do with managed futures. Here's the quote that Jerry and the other Jerry put up there this week in Twitter of me saying, "I cleanse myself of any pretense of caring about diversification." But I should have said, "I cleanse myself of any pretense of caring about smoothness, except for this sort of accidental diversification and accidental smoothness we all get and we want because we're so diversified."
Hey, I do have a question on this, if you don't mind. So at the moment, I'm not trading individual single name stocks, but I'm in the process of incorporating them into my portfolio. And the question is, so for instance, to be able to hunt outliers, which we all do as trend followers, it makes sense to incorporate, Tesla, Moderna, Apple today. Okay, so I can definitely close my eyes and incorporate Facebook, Microsoft, Amazon, Google. I know, and when I do my back tests for the 20 years, 30 years, of course, these back tests are going to generate amazing amount of profits because those are the winning stocks. I know I know that I'm picking the winners. And that's where my problem lies, where I do have huge, on the mind, I'm not comfortable. And I would like to hear, your views, particularly, Richard and Jerry and whomever is trading and incorporating stocks into their back tests. How you're getting comfortable on this hindsight bias? It's like, betting on a horse that that horse is going to win. So of course you can bet that horse, post event, but and it is not going to impact your trading today. You will still able to hunt outliers, but my only concern is the validity of the back tests that you're doing, from that point. Thank you.
Yeah, that's obviously a problem, and I agree with everything you said. So obviously you're anticipating my brilliant answer. And number one, I would never put myself in that situation. And when you're choosing, I've said all of these things many times. When you're choosing markets to trade, whether it's stocks or the futures, you should never look at past performance. And when you're choosing the systems to trade, I would not want to look at my historical equity curve. As you well said, Tesla and Moderna are going to heavily impact. And in fact, I'm perfectly comfortable and have done this before, and that is I will choose systems to trade without including equities in the back test. And I have chosen because all I want to walk away from is, where's a pretty good place to buy? Where's a pretty good place to sell? What's going to keep me in these trends? I can come up with these long-term trend following systems without any vol management and correlation management, just by looking historically at the futures markets, no stocks. And my big takeaway is going to be, what was my average trade, my average win, my average loss, my win percentage, the trade stats. So I pretty much never look at history. And when I chose a lot of these stocks back in 2018 or 19, I have a tendency to have a fixed portfolio and not kick stocks out of the portfolio or any markets out of the portfolio. The back test was particularly bad. In fact, when I did a replacement and added more stocks and different stocks, because I was just looking for diversification. Now, and I added Tesla and Moderna, believe it or not, just because of the diversification qualities. And Tesla had not made any big moves, and it was that most heavily shorted stock around 18 and 19, I believe. So the back test came back far inferior to the group of stocks I had on before. And my research people were going, we hate these stocks. They're no good. Our back test performance is less. And I was like, I don't care. It has nothing to do with history in these particular stocks. We added these stocks, these commodities, these currencies and bonds strictly due to their diversification benefits and liquidity. And so adding new stocks, and we paid no attention to how they performed historically, only that we felt like giving some sort of correlation metrics and common sense that they were somewhat different than everything else in the portfolio. So that's how you should do it, and pay no attention to the historical back test other than the trade stats: average win, average loss, average trade, win percentage. That's all I ever pay attention to. How was that?
I like this idea very much when I first have heard this from Jerry, because it's really, we apply general rules to every market, and because these rules are universal, general for all, of course, according to this logic, all the markets have the same expectations. We must expect the same from all the markets, and it's our transform philosophy. So I appreciate this much.
Can I ask you a question? Do you include equities that are very low volatility ones, like I don't know if I'm right, like McDonald's, and use them too, or do you tend to put in equities that are highly volatile?
Well, it doesn't really matter, since we're sizing based on ATR. I do have a preference. Rich has mentioned this before, and I agree. I would have a preference for stocks that are not the largest stocks. Let's say if I had a choice between two stocks that were in an interesting two. Okay, so I have a company that is an egg producer, and one that is French fries, and I added potato chip company this week. So if given a choice, I would choose the ones that were not as large and not as diversified, because sometimes you get into these companies and they're so diversified, they don't really have one stream of business, so they act more like an index possibly. I say possibly because you'll be flipping through a chart after this spaces and you'll say, oh, Jerry's wrong. There's a big, huge trend in Berkshire, or a really large company that's very diversified. So I think it's very difficult to I don't think you want to overanalyze this too much. Just be more systematic and rule-based on how you choose things. So obviously I like stocks that are, have a $20 share price and above, and an ATR of $1 or $2. I probably wouldn't like to have a stock that was $5 and a 25-cent ATR. So I have basic kind of money management or preferences. There's just so many to choose from that, you probably can find some that are going to suit your needs as far as diversification goes, and will kind of fit in with moderate market cap, moderate volatility, moderate share price, and things like that. So I wouldn't, but I caution myself frequently to overanalyze this thing. I think one of the lessons of 35 years of doing back test and trading is that these markets prefer a more general approach than a specific approach, fine tuning that parameter and that algorithm down to 2 or 3 decimal places is not nearly as good as a more general approach. The back test, the computer just really doesn't like too much specificity.
Thanks. I think, I don't know if you already did it, but some interesting backtest would be to have that simple criteria and put it into the computer, and that the computer would pick random portfolios and see how trend following works on a couple of many iterations of sample portfolios that are of companies above 20, etc., etc. What I was thinking about equities, when you said that you if I understood correctly, that you will have more risk on the equity side, is that when things go wrong, as you said, all those correlations go to one, and maybe it's because of the risk, what people call the discount rate risk. That everything is expensive because there is zero interest rate, and so all the companies are very expensive because of that. Isn't that kind of putting too much risk on a single cost, which will be that discount rate? Although I understand that stop losses will work and will break that correlation, but isn't that putting on the wrong side? Because I understand that outliers will be great, but putting too much risk on a single, let's say, economic event or economic cost?
I think the assumption that we've got to avoid is assuming that all of our equities we're long only. So across our equities, we're a combination of long or short. So when we do get into this crisis, we can find that the ones that are already short actually get a bonanza from being short. The ones that are long are the ones that get caught with the positive correlation. So I think we've got to be careful of assumptions dealing at the sector level, because it's basically assuming that we're positioned all the same direction, and that's not the case with classic trend following, as far as I'm aware. But what do you think, Jerry?
Absolutely, that's what I was saying earlier. Is that when stocks go down and everyone else is long, their choice was, what should I be long? There's no option to go short necessarily. There's no systematic approach that gets out at the 100-day low, So it just all depends on, how many longs we have on, how many shorts we have on, how close are we to getting out of some of these longs when it reverses. Diversification fail happens in all the sectors. It happens across the portfolio. That's why step one is, are you going to trade 4 units or 5 units? I mean, that's a huge, you have all sorts of problems creeping up. This has happened to me many times, where I'm like, oh my gosh, I was trading too much stocks, or I was trading too much currencies, or too much commodities. I got caught. Why don't I have more diversification? And then I later realized, after my emotions settled down, oh, I get it. I was trading too large. I had on 10 units of risk. My risk budget was 10 units. I think I'm more comfortable around 5. So you get these false problems. You analyze your own deficiencies incorrectly. Most of us, we trade too large at different points in time, and we blame it on the system. We blame it on the diversification choices, the length of the look back, where essentially it was pretty much just we traded too large to suit us. And some people Mulvaney can handle it. He doesn't bother him. He sticks with his system. I think it bothers me a bit more. So I think on one hand, I might be longer term than Mulvaney, looser pants, bigger drawdowns from the peak, but his returns are bigger, pluses and minuses are bigger, because he uses more leverage, more risk than I do. But I think that's our benefit that we have, is that if we're good, if we focus on diversification across the portfolio or in the sectors, in the stocks themselves, we can find stocks that some will be in an uptrend, some will be in a downtrend. Everything goes to one. We break even. We make a little bit, we lose a little bit. This can absolutely happen. Now is a perfect example. If you did any sort of analysis of the stocks, you would see what I'm talking about. It's pretty crazy how we'll have 150 to 100 stocks today hit the 100-day high, or the 125-day high today, more than likely, and 3 to 5 will be the 125-day low today. But we're in a bear market, so there's a lot of stuff happening outside of these indices. The S&P is very weak, but there's a lot of stocks these days that are very strong, and we'll have to see what happens. I think that the biggest mistake the CTAs have made, managed futures has made, is not trading stocks. They're not taken seriously. They're not making profit on some really great opportunities. They can go 10 years when the Fed is doing its crazy things and not make money and have to apologize for it because they're overweighted in currencies, commodities, and bonds. They trade indices that don't have outlier moves. They focus, unlike any other hedge fund sector, on smoothness. No other hedge fund sector really macro focuses on how smooth is my portfolio. Am I vol targeting, correlation managing? No one except the managed futures people. So everyone needs to break out of that and make trend following your top priority, hunting outliers, letting profits run. The CTAs who are in the managed futures industry have contaminated and corrupted trend following with all this other crap, and they don't have any assets under management. And so a group of people need to break out and continue trading the currencies, commodities, and bonds, and a healthy dose of stocks, so we can have this all-weather portfolio, but not sacrifice the trend following piece, and actually replace buy and hold equities with something a lot more safer, which is a healthy dose of stocks using trend following with inside the CTA's quote unquote perfect portfolio.
And I want to say that I personally see a very big benefit, another big benefit of diversification, and maybe I will to talk about this as an example. For example, we buy SP 500 as an index, and we can also buy maybe 100 stocks from this index. And if stocks go to one, stocks go down in the crisis environment, and so on and so forth, maybe 20 or 30 stocks from these stocks, we will not take a signal for a trade for a signal. So maybe 30% will be not in a trade from these 100 stocks. And when we buy index, we have 100% of the money there of our risk management. So it reduces our drawdown, and we can say not good environment for us, but not all the trade, not all the signals becomes our real trades when we trade stocks in a more diversified way, even in stocks and currencies and commodities and bonds, by the way. And I see this, and so our drawdowns get reduced because of this, and it's a big benefit of diversification for me.
Hi all. I just wanted to say, I thought Jerry's point about the reducing the risk size, I thought was really important, because what we do, we trade basically all liquid stocks that are tradable on interactive brokers. So we don't really worry about do we have enough stocks in a particular sector and things like that. We just trade them all basically, and basically hunt any outlier that exists in any market, and not really make any sort of decisions on it. I mean, the only thing we do is just to basically limit stocks that have very, very high correlation, like above 90%. But apart from that, we don't really fuss too much about the diversification aspect, because getting the outliers is more important than the diversification.
My new best friend. Yes, of course. I love that.
Yeah, I also did tests as well, just on various commodities. Just looking at eliminating perhaps some commodities that are higher, more higher correlated. But I mean, from my research, it just pays to just trade them all, really. I mean, even ones that are 70%, 80% correlated, like soybeans, meal, say, for example. It just pays to just trade them all.
That's right. And I have tried to go through the stocks and choose ones that are commodity related. Like I said, eggs, French fries, now potato chips, and then get some sort of commodity-like exposure, that I can't get in the futures. Oh yeah, I also was interested, recently. Well, get some stock exposure that may have some correlation to futures, like lumber. So I traded lumber, and it had a pretty good run, but it kind of crashed. And then some of the lumber companies, they went up as well, but they didn't crash, and they kept going up. And so the chart looks a bit different. It's not lumber, let's say. It's not lumber, but it is lumber related. So they have the dynamics in their company where they're making more or less due to the input of their cost of goods sold, the lumber. So sometimes it'll be beneficial, sometimes it won't, and sometimes it'll be highly correlated or less correlated. But it'll be a different type of trend. And in this scenario, it was a better trend. Oh yeah, and the same thing happened with shipping futures. There is an ETF in the U.S. that contains shipping futures, and because I can't figure out how to trade these shipping futures, I've been looking at that shipping futures ETF, and it had a big run up. And so then I started comparing that to shipping companies. And once again, I think the trends in some of those were a bit better, because that went up and crashed, where some of the shipping companies, container companies, oil tanker companies, they had some better trends, different types of trends. So not only, so don't look at some of these companies and say, oh, I have that covered with the futures. You have the futures covered. You have the raw commodity covered, but there could be some opportunities, and then you got markets like steel and where you don't really have a future, uranium, lithium, all kinds of things that are out there and only, pretty much stock only.
By the way, I like this idea, and I like the idea that commodities. I have thought a few years ago about this much, that when the price of a commodity and the price of a particular company, or of stocks of a company that trades commodities or produce commodities, it's not the same thing. And as I have heard, I don't know, is it the right version or not, but I like it. One guy said that price of a stock, it's a faith of a people that the company will perform well. So in any way, it's very different things. Commodities prices, commodities and stocks. It's very different things, and I think that because commodities, it's stocks, it's a financial instrument, and commodities not.
One thing here. Overall, I believe that the issue of portfolio selection is what instruments you decide to look at to actually make trades. A personal and more of like an art form to yourself, rather than it being a rule, us having a mechanical rule like we do with breakouts or position sizing. We have to make that choice before we start, and at that's different for everybody. I've run experiments with different portfolios that have different selection methodologies. Some might trade more stocks, some might trade more commodities or bonds or whatever. And I think other people have done this too. And it's not with the goal of trying to find the best thing, the best portfolio that tested out in the past, and that's the one we're going to go with in the future. Me and Jerry have done this many times. We're not going to find the best stocks in the past and then go with those in the future, because some of the best ones that have produced the best moves over the last few years didn't exist 10 years ago. So what is, I think that's another, key part of, and maybe sometimes a random luck, factor involved in how you select and what you choose to, and, what you choose to trade and what you choose to just look at, and then, take your breakouts and your position sizing from there. But yeah, to think about a way to.
Yeah, I agree with all of that. I do think, though, that if one trades lots of markets, more than 50 or 60, because you only need 50 or 60 if you're not hunting outliers. But if you want to hunt the outliers, you need hundreds.
Yeah.
And so I think that you can say to yourself, wow, you got lucky. And it was lucky. Some of the stocks we only added because of diversification. And then we got, quote unquote, lucky. Well, how did you get lucky? Well, we trade 200 markets. Well, you made a good decision trading 200 markets. You can't write that off all as luck. But I think you're basically right with the the choosing of the stocks, and we've run these research tests where we would randomly select 100 stocks or 200 stocks or 300 or 400 up to 1,000 stocks, just randomly select them and trade them, and the performance was not so different, honestly. So we're back to then what's going on here? Well, because Professor Brennan told us one of our key factors of risk control is the small bet size. And when I take a full loss, and my stop loss is fairly a good distance from the entry, it's very healthy, probably bigger than most everyone else's. I lose 18 basis points. Okay, so small, and so I don't like buying something and having it go down immediately against me and have a 2 or 3 ATR loss, but it's not very much money. And so it gives me like this superpower. And so then when I go to 300 markets, I'm going to risk 12 basis points per market. So I'm going to have even a bigger smile on my face when it comes to having to deal with the market move sometimes, that unless I'm getting a 50, 100 ATR move, it's not that material. Now, you could have, like last month, I think I calculated, I lost 166 ATRs last month in my portfolio. All right, so that's real money. It was a combination of everything going against me, almost every market going against me. But look, it is very good to take these small bets and have these unfortunate things happen that are not going to really amount to a whole lot of money most of the time.
Jerry, can I ask you a question about that? Because given the size of your R, you don't have to care that much, as you said. But in any case, do you still do some kind of, I don't know, back test, study, drill, etc. about what about if everything goes the wrong way for me? How much of the capital will that consume? I ask you this because many times people who comes to trend following for futures in general, but to trend following, and they don't know much about it, they get kind of scared about prices going over the stop losses, and it's something that they don't. Even some of them, they don't want to get that risk. So I was wondering if you. I know that your R is very small, but do you make some kind of drill about that or not?
Well, I feel like that the way I have set everything up, that I'm not going to be unpleasantly surprised by that scenario. It can happen. However, I sometimes go in and look at all my positions and I sort them based upon the date of entry. And it's all over the board. 2 years ago, 3 years ago, all the way up until yesterday. So I'm taking the words you used literally. And so I'm trying to defend a certain equity level. I think it's very problematic as a trend follower, or as a manager in general, to try to defend the maximum profit in a trade or in your portfolio. That's going to lead you to vol targeting, correlation management, vol management, and a unhealthy, non-systematic trades called risk management overlays, because you're defending your high water mark. I defend the capital, closed equity, the initial investment plus realized profits and losses. And I don't move it up very fast. I move it up maybe once a year. And I can easily do that. And I'm looking at losing trades. And since I'm spreading these trades out over many, many months, many different types of markets, longs and shorts, I would have a tendency not to put on a lot of trades at the same time or similar within a month or two of each other, and be subject to many of them taking losses and eating into my capital. Far different than probably maybe what you meant, which is, oh no, when you're making tons of money and you've had an incredible winning streak like you've had, then you have a month like July and everything goes against you. You know, my stock answer is that's open trade equity. I'm not paying that much attention to it. I'm paying attention to my closed trade equity and making sure that my closed trade equity is ever increasing, and we're not getting close to a drawdown in that, because I'm preserving capital and I'm redefining capital as closed trade equity, which allows me to let profits run, maximize the outliers, maximize my CAGR.
I'm loving this conversation, Jerry. You're hitting it out of the ballpark today.
I'm just hoping that the professor is smiling and giving me some positive feedback. We need a spaces that has videos. We can all see each other. You'd be seeing me walk around my house today, drinking coffee and making coffee while Oleg is talking, but I'm still paying attention, Oleg.
Oh, by the way, I'm in a very beautiful place, and I have said before today, I decided that I love Transform. And by the way, it's not the first time in our spaces when I'm here, at least second or third. And I especially came here to be in this place because one of the best places in the world, the loveliest place in the world, for me personally, from my childhood. In my childhood, my parents showed me this place. It's here's very clear sea, warm sea now, clear, very beautiful nature. So I love this place, and I love trend following. And I think it's very important to have things to every person which he loves. It's very important.
How was that answer?
Well, that was a great answer for me. You know how it happens that when you're speaking with clients or people involved, there is there is a risk of using these kind of instruments, and not so much on the strategy, but there is a fear, and which I think it's good, because as Cliff Asness said, the three dirty words of finance, and one is derivatives, the other is leverage, and the other is shorts. And I think those are great for reducing the risk of not meeting your objectives. But at the same time, sometimes it's very afraid for people who are not in the market and don't understand how they work. But stop losses, which are great, a great way of getting protection for people who are not in the world of leverage. They seem very, very risky.
Yeah, I agree, and I think that it reminds me of we all want to go down to the local drugstore and purchase something that's going to make us feel better, and that usually works. I mean, it works like all the time, but every now and then we have to have surgery, and it's very complicated. It's very scary, and we put our hands in a person that we think is incredibly trained, that we cannot come close to doing what they do. And yet this person is going to be the one who's going to save us and make us feel better. It's the only alternative left. And I think if you want to have this type of portfolio where you don't have to worry about it nearly as much as a single sector, long only, or whatever, then you do have to embrace things that sound scary, but in the hands of people who have experience and know what they're doing, it is the best choice. And but there's just too many people out there that will give professional advice that it's unnecessary, it's alternative, it's 5% of your portfolio. And the people who are trend followers, they're fine with just taking that 5% and not rocking the boat. It's shocking, I was reading on Twitter people posting things of like, hey, here's what you need to do when the market goes down, which is basically just do nothing and just sit there, and it'll always come back. And this is an industry that has been built up where people really believe that stuff. And it's not it doesn't fit with my personality.
I see that a lot of people, I say that have such a bias that they want to hear what they want to hear. So when they hear something that they are thinking is good for them, they choose this opinion. Maybe it's an ego problem. I don't know exactly what is the reason of that, but it's psychological bias. And people say, I know, for example, when it's the reason because of such a Bitcoin funds and so on and so forth are so popular that when they see 1 or 2 years track record of a Bitcoin, they see this very big performance, and they don't want, have seen this for a few times at least, that people don't want to hear about risk, about hiding risks, about how how investing world works. And they don't want it. They only see that, oh, it's very good chance for me to have 1000% a year. It's very good chance, and it doesn't matter what is the reason of that. All in the world have a reason. We as Transform, we don't have such a, it's our very big benefit that we don't have a requirement to know all the reasons. And in fact, we can't know all the reasons, but when we see 1000% font performance, it's a reason why it is so, and it means that it's a very, very, very big risk here, and a person must at least think, is there a risk or not? At least think about that risk. It's his own money, his savings. Why not think? But people give money for such funds because they something psychological biases, I think.
So, it's very, one of the things that makes this group obvious is, we are having this conversation where, US jobs actually added, more than 500,000. And the market actually just turned the other way around, and we just really do not give much attention to what is happening because the systems that are trading are actually taking care of what the nitty-gritty of the stuff, basically. So it's a very trend following quality, I would say. And in terms of using the leverage and the long and short, so there's a certain skill in the trend following space to be able to use leverage and to be able to use long and short. So yes, it is a particular concern when a position might just jump over a stop and you might end up with a big loss, and you might blow out your trading capitals. And the answer to those questions is always to be able to, Richard actually has mentioned this thing a few times, which I agree with him, is your bet size. Your small bet size is the ultimate protection. It's not the how many basis points you are risking. It is the small bet size. So you're gonna come up with a small bet size to be able to protect individual markets, basically, and hope that you're not going to end up with a systemic risk where the entire financial industry is coming down, and the risk of that is negligible. And if a systemic risk happens, it impacts everyone else. So if you put the systemic risk aside, a trend follower can easily manage a USD Swiss franc move that happened in 2015, where the market came down in an unorderly fashion. So that's what I would say. The previous person that asks about how you manage a trend following strategy, because the bet size is small. I really don't care if I lose 50%, 60% on a position because it's small. So I can live happy days. Thank you.
That's right. And so since it's so small, and the consequences are not going to be material unless you get this outlier, it helps you kind of sit there and wait for the outlier. And then that Swiss thing was so amazing. And I think I actually made money that day because I had a lot of the Swiss crosses on. And so I broke even or lost just a little bit because I was heavily diversified in dollar Swiss, euro Swiss, sterling Swiss, Canada Swiss, Swiss yen, Aussie Swiss, etc. So yeah, once again, I think the small bet size, that's our ultimate, it's one of our ultimate risk controls. And you're going to get smaller and smaller as you add more and more markets. However, as you add more markets, your total risk budget can probably go up a bit. So 5 units with 100 markets, maybe 5.5 with 200 markets or something like that. But it's a beautiful thing, all this diversification, all these small bets. It's such a different way of trading. And it's not something that I'm really that familiar with. I started with 20 markets, and I maybe I've been trading 100 markets for many years, but 220 now, on the way to 300. But with stocks, and a lot of the CTAs, somehow they trade a lot. Some of the CTAs trade a lot of stocks. Trust me. I get the 13F reports and I review them. A lot of the hedge funds, global macro, trade a lot of stocks, hundreds and hundreds of stocks. But supposedly some of the CTAs, Florin Court, and I can't think of the other ones, they say they trade a lot of commodities, China. But yeah, the more markets, the better. There's no diversification concept in systematic trend following. Every trade has the same expectation.
Yeah, the great thing about small bet sizes is it doesn't matter how small you go, it provided you're adopting an equal weighted risk bet, means that the relationship between the outlier and the loss, you retain that asymmetry, no matter how small you go. The outlier is effectively independent of the scale. In other words, if you have a small bet, and you think in terms of R or ATR, you might take a 180 or 280 R loss, but you'll get potentially a 20 ATR win or a 20 R win. The asymmetry is still there, and provided that at the portfolio level, all of your return streams are equal weighted, that asymmetry is totally preserved no matter how small you go. So ideally, the smaller the bet size you go, the more diversification or the more return streams you can pack into your portfolio. And I think where the trend following solution comes in is that it really is solved at the portfolio level when we look at how our method compares to alternative methods that adjust their position size per return stream, so that at the portfolio level, certain return streams become dominant over other return streams at the portfolio level. We prevent that occurring because of the technique that we apply, and that the stops and the trailing stops release this risk in the portfolio, which other methods don't have, which means that when particular return streams, so at a portfolio level, a return stream without a stop or a trailing stop that gets hit by the Swissy event suddenly finds that it dominates a portfolio result. Ours, which, the small bet size, hopefully the stop or the trailing stop, it might have slipped through them, but essentially that equal weighted nature of the return streams is much more preserved than alternative techniques. So it from a risk management perspective, we can absorb more risk into the portfolio because we are spreading that risk out across all of the diversified return streams we've got there, which means that we're much more robust, and we're not we're not prone to be hit by a single event in a single market that's going to translate into very little effect at the portfolio level, as opposed to alternative methods that might, volatility target or adjust their position sizing on a return stream because of trend signal strength and all of these things. They've got to take correlations much more into account than we do. We don't have to worry nearly as much about how correlated our portfolios are.
I always say that I have said before, and I like the idea of Jerry said this and appreciate it much, that it's more important and to add more markets than to add these different techniques. And I had a big back test on this topic a few years ago, 5-6 years ago even, but 3 years ago, that when you add different uncorrelated return streams, it's the best decision. Then do your trading activity more complex at least, and do this fancy strategies. And Jerry said that maybe in one of the previous episodes of Top Traders Unplugged also, and said before, and very important for me personally, this information is very important for me personally, because making something complex must have a reason for that. And I don't see the reason of making more complex my trend following strategies. I don't see the reason. And if we are talking about, I have a little maybe martial art background, and here's the same thing when we talk about classical martial art, karate, kung fu, and maybe aikido. There is a simple based simple concept, and doing it more fancy is it's not in many cases it's not a very good decision. At least a base must be very simple, and it must be proven with a very, very long track record or back test or back test.
I have run into situations though where, so when I start out, like I said, I have all these defenses built up. I'm walking onto the field, and I'm trying to be as prepared as possible beforehand. So my trade level is conservative. It doesn't move up very much. I take these small losses. I trade a lot of markets, so the bet size is small. And so I'm trying to be as prepared as possible. And so with all of that, now I can afford to let those profits run and not vol correlation manage or have an overriding risk management that frequently increases or decreases positions because of losses or volatility. However, these little tiny positions, these small little bets, if not constrained by the increase in volatility or correlation, they grow gigantic and they have a tremendous impact. The drawdown in Tesla was horrendous. It was huge, as was the profit in the Tesla trade. So if you're trading the long-term strategy and not reducing your position throughout the trade for any reason, the return volatility for the month of whatever, you could be the only CTA to lose money in a certain month only because of the drawdown in Tesla. However, best performing CTA for the year, right? Because you had Tesla and Moderna. So the focus for most CTAs would be you cannot have that sort of relative underperformance. You've got to keep these trades under control. Unfortunately, controlling them means you make less money. You don't make as much on the outlier, and that's why. And that's the focus on smoothness and not having these, and the focus on period returns. Whereas my focus would be totally on trade returns. What happens in between the Tesla entry and exit is of no concern. It's not impacting my trade level, for one thing. If it impacts your trade level because you're using total assets or AUM on a daily basis, wrong. Then don't do that. They made a mistake. They shouldn't do that. Then they have to do something else to correct that mistake. Just don't make the mistake from the very beginning. Your trade level should never be current equity. It should be the way we've laid it out. Closed trade equity, and it doesn't move up every single day. It stays constant for a while. So I think this is, people make these mistakes and they have these bad thoughts. Not hunting outliers is a primary one, desiring smoothness and consistency. And ironically, you'll be way more consistent on an annual basis. You'll make money more frequently on an annual basis, the less you try to manage each particular trade.
And I think, yes, I appreciate this very much. It's very important information for all of us here, I think. And I think that this robustness, this consistency, robustness leads to consistency, or consistency leads to robustness. And as Neil said, that consistency is not a thing that a lot of investors think the robustness, the consistency is. So, following our rules, it leads consistently and disciplined, following our trend following rules based on trend following, which is based good rules, which is based on trend following philosophy, leads to a good result in the long term. And I'm absolutely sure that it is so. It's a truth.
Jerry, a technical question doesn't matter very much, but you said in this conversation about closed equity that there was a change on the calendar, and then you said closed equity in general, which is in your opinion, is there much difference between having a running closed equity as a base to do the trades, or is it better to adjust the closed equity once each 3 months, etc.?
Well, I prefer to use closed trade equity for the trade level and then update it. I would update it when I had a material reduction in open trade profit. So maybe, I know I threw in the calendar thing, just trying to emphasize that I don't think you want to update it daily. But ultimately, one of the most important things, we all think this is like so important, and yet problems creep into our systems and we don't realize it. And that is consistency. So I've got the same risk budget, I've got the same trade level, and I'm doing all these trades the same. I've got the same system, longs and shorts, every market. I've got the same ATR calculation, the same trade level, and the same unit size for each market, okay? So we prize this consistency in handling each trade the same way. There's many elements to how you handle the trade. So obviously we're making money. We have this problem, made too much money. We've got to increase this trade level. We can't keep it constant all the time unless we distribute the profits to our clients. We have $5 billion under management. We make them $1 billion or $2 billion. We distribute it. We can keep our trade level of $5 billion all the time. That's not reality. $5 billion is not reality. Distributing the profits is not reality because we want to grow. Okay, so I think it's better to try to keep it sort of constant. So we have this constant bet all the time. But we do have to have a choice where we say, okay, I'm booking these massive profits in commodities. I probably should increase my trade level now by 10 or 15 or 20%. Here's a new trade level for all the new trades starting today going forward. Someone, it may have been you, posted something about Argentinian bonds.
Yeah, it was me.
So the Argentinian bonds had this big downtrend, and then the volatility started going a lot lower. And so the vol management people would have a tendency to increase the position. So you increase that position, and it had a tremendous rally, a 30% rally, I think you said.
In 1 week.
Yeah, so huge rally that was very painful. And because they changed the size of the trade from what it was at entry, it may have wiped out a lot of the open trade profit. So we don't want to go around changing these position sizes due to vol adjustments, due to trade level adjustments, and wipe out a whole stream of profits because we're essentially not treating these trades in the same way and increasing risk at the exact wrong time. And so I think that we just want to be cognizant of trying to keep things the same as long as possible. And there's making the same. It's good to have small bets. It's also good to have the same bet. And that's what I'm kind of getting at. I don't think it's crucial and critical, and I don't think it probably shows up to be very material in the back test. However, I've seen things. In 2008, I saw things happen that I had never seen in the back test. So a lot of times I'll go through our strategy and say, well, what about changing it in a certain way? And we'll all say, oh, no, we don't want to do that because something we may have never seen before might have a negative impact. So once again, don't believe those back tests. It's going to be worse. And it's better to have a more principled approach, theoretical, philosophical approach to risk management than running a back test saying, oh, wow, we can get away with a lot of crap here. Resizing our positions frequently with current equity. I think that's a huge mistake. And we saw it show up for the first time in 2008, basically how devastating that was. And so that, and obviously we didn't need to see it. It's obviously a mistake. You don't want to change these trades halfway through the trend. It's, obviously it's going to hurt you at some point.
Yeah, and I think even in 2008, it could have been much, much worse because there was time to revert some positions, not all, but some. So if something happens that it's more faster, it could be worse.
Yeah, one of the things, because we are trading these outliers, we've got to be prepared to have these give backs when the trend ends. And that's just a symptom associated with our technique. So in other words, let's say you've got 6 separate trend following systems or 4 separate trend following systems like Jerry has, and you're committed to an outlier. What that means is that there's a very good likelihood that all four systems are going to be fully engaged in that outlier when it turns into an outlier. Initially, there might be one system active, then another one comes on a bit later, then another one, etc. But by the time that outlier ends, you're fully committed to that directional outlier. So that inevitably there is always the give back when that trend ends. You can't help it. It's just part and parcel of having to suck up the fact that as classic trend followers, we have volatile, unrealized equity, and we just got to suck it in because if we do tamper with that, we are tampering with our ability to let profits run, and we don't want to do that.
Get inside your bubble, get inside your trend following bubble, and redefine capital, redefine what losing trades are. It's losing trades. It's taking a small loss. Volatility in open positions, huge monster winners, is not risk. It's not loss. But as soon as you step outside of your trend following bubble into this real world, unprotected, everyone else is saying something different. And then you hear trend followers saying something different. Yeah, they've all managed, they correlation manage, they have risk management overlay. The primary importance is how did we do in July? Not did we maximize the profit on this particular outlier. So that's when you got to retreat back into your bubble, your protective bubble. And that's what we had in 1984 through 1987. We had this protective bubble where our boss said, do the right thing, do the hard thing. If you make money, it doesn't really matter. If you make money doing the wrong thing, you're going to get in trouble. If you lose money doing the right trades, you're not going to get in trouble. I'm likely to give you more money to manage. And you're like, oh, wow. And then that's part of the experience where you're not only learning the rules and getting experience, but you're getting this feedback that's almost from another planet. It doesn't really exist in our world. And people succumb to it. And they transform these businesses into what used to be trend following into now this crappy thing called managed futures. And it's sad. So take your knowledge of trend and letting profits run, apply it to as many markets as possible. And it's a great product that nobody knows about because they've been contaminated by managed futures CTAs that don't really trend follow. So it's stupid to call it classic trend following. There's no difference. Classic trend following is the same as trend following. Almost no CTAs actually trend follow. It's a much different strategy, but it does collect a lot of management fees.
And I like the idea that we always have a plan. Neil said this before, that we, as a trend followers, we always have a plan to do. And by the way, Mark Jabrzinski said that we can see a similar situation in the military forces, that people in the army know what to do. They have a discipline and they have plan to do. They have a system what to do in the different stressful environments. So we know what to do, and of course we never have faced something like 2008, like 2020. And in fact, every day can bring us a lot of surprises. But we are really prepared because we have a very good plan that is based on very good rules. So we do all the same things in the different situations. And we don't even think a lot, be overthinking here about this and be too complex. And a lot of guys who do something that is based only on the past performance, but not on the rules of general rules of nature, as I say always, they can face a big, very painful experience with such things like 2008.
Well, I think that has to do with, for me, if you see alternatives, like, for example, the buy and hold, there is a culprit of the problem with that, and I think it's Bloomberg or Yahoo Finance, because when you see the chart of an equity, many times you see that it goes down 80% and then recovers, or 50% for the indexes. And what the chart doesn't show is the churn of equity holders, because it looks like you just were able to go through that huge drawdown, and then you were rewarded at the end. But I think that most of the time, the people who got the good part of that curve were not the same as the one who began, and that's something that doesn't show anywhere. If you see the chart of Citibank, it looks like it recovered, but what didn't recover were the equity owners before 2008.
That's right, and that same thing happens with CTAs as well. It's really I was really nervous when 2021, the people, middle of the year or even the end of the year 2021, people were talking about getting into commodities. And I was like, oh my gosh, we bought those breakouts in commodities and the grains in the fall of 2020. It's just so important to, obviously, this is somewhat obvious, to do that trade when you're supposed to do that trade. It's really problematic to start a new fund, to start a new account when after you put on a lot of open positions. I've heard people say, well, my system says I should be long and short these particular markets. Well, not really. The system said you should have put them on the day that they broke out, which could have been months or years ago. So it's kind of a sketchy situation, risk control wise, to do that. I saw a tweet from Tom Basso saying he did research that showed that you should put the trades on as soon as possible and you make more money. I'm sure that's true in general, overall. But it can get a little dicey when people start into a new program and put on all those trades. They could go into a really nice drawdown. So it's not that great of a situation. So putting those trades on when you're supposed to and holding on to them, that's what the system is asking you to do.
And Jerry, when you went, because you said you started with 20 futures and then you went to 100 and then to 200. When you went from 100 to 200, I guess what you saw is that if you get more futures, then you get a good chance of having more outliers, and that's what compensates. Because you talked about leverage, but you said that it's a tiny difference in leverage when you go from 100 to 200. But is that something that you saw out of the box, so to speak, or you saw through the back tests?
Oh, I think both. We obviously saw it in when we, in the fall of 2020, when we started buying those commodities, the grain markets, and there were a couple of those grain markets that had much bigger moves. I'm trying to think. Canola, rapeseed, palm oil. So I did at the same time add a lot of the smaller commodities. One point, that's kind of interesting is that Niels has pointed out on the podcast that he just doesn't see the difference in performance. And so I took that seriously. And I'm like, he doesn't see the difference in performance from 60 markets to 200 markets in the back test, and certainly not in real life. And I agree. And I think there's a logical explanation, because the performance you see in the CTA industry comes from the 99% of the people who manage volatility. So that's right. If you're not going to play for the outlier, then you're making the outliers not an outlier, profit-wise. You're in the outlier with this reduced position in canola, rapeseed, palm oil, sunflower seeds, white maize, yellow maize, you're in those positions, but you didn't get that outlier performance. So you're screwing down all the potential profit, making them all very similar. And you're back to this whole strategy of traditional people saying you only need like 20 markets to maximize your diversification. That's right. Get rid of maximizing diversification, but you need as many as you possibly can find in order to hunt the outliers in a safe way by making those small bets. So it is absolutely true that most of these CTA performance is due to sector movements, and there's not going to be a lot of difference between corn and soybeans and rapeseed and canola. And you know what? If it is, I'm going to get rid of some rapeseed and canola to bring those back in line. Sad situation.
Actually, Corduri, you'd be aware, I know you're aware of Jez Liberty's work where he did a scatter plot, and the scatter plot looked at the relationship between KGAR and max drawdown. If you could imagine, let's say KGAR is a horizontal axis and the max drawdown is the vertical axis. So I've done this research where I've looked at levels of diversification and where the plot is for the portfolio. And an example is, let's say I had 100 different markets to diversify into, but let's say to start with, I only wanted to diversify into 5 of those possible 100 markets. When you plot, let's say, 1,000 portfolios of 5 randomly chosen markets out of that possible 100 markets, you get a scatter plot that's very dispersed, and each individual plot plots right around that KGAR max drawdown chart. The scatter plot is very dispersed. As you increase the level of diversification, you find that so let's then go to 20 markets out of a possible 100. Then you plot that possible 1,000 portfolios of 20 different selected markets. When you do that, you find that the scatter plot actually starts concentrating towards higher KGAR and lower maximum drawdown. That's telling you that the level of volatility in your portfolio is reducing and your KGAR is increasing. And a lot of that is to do with the selection bias associated with a portfolio of 5 out of 100 markets versus a portfolio of, say, 20 out of 100 markets. As you increase the level of market diversification, you're reducing your selection bias because you're starting to select all markets. Then when you increase that portfolio level to, say, 80 out of 100 markets and have 1,000 different portfolios, you find that the scatter plot really concentrates towards the higher end of KGAR and the lower maximum drawdown. So it's progressively getting to a better risk-adjusted relationship in terms of KGAR and max drawdown. But when you do it to other methods with negative skew, you find that there is a similar distribution, but the KGAR actually starts plotting to the middle of the scatter plot. In other words, with other methods, there is this sort of maximum diversification limit where additional diversification doesn't really assist. And this is because in the scatter plot we're talking about with classic trend following, or trend following as Jerry's now referring to it, it's the impact of the outliers in that sort of diversification ensemble. The impact of those outliers is what's migrating that KGAR to a higher KGAR. It's because of the non-linear relationship of those massive outliers in that total distribution of a much more diversified ensemble that's actually pushing the KGAR to the right and pushing the drawdown lower because of the diversification benefits. So the diversification benefits are coming from a reduced max drawdown, but the outlier benefits are coming from the higher KGAR. I'll post that little research piece up on Jerry's Twitter feed underneath this, just to show you. But Jez Liberty did a similar exercise and found a similar thing happening.
Yeah, I miss Jez. I had an opportunity to meet him in New York City many years ago. So I'm not sure where he is. I know that every now and then I hear someone wondering where Jez is, but I don't know if he has a presence any longer on on the web, on the internet. But people will talk about exits are more important than entries, and I don't think they are. You can get the impression that they are because you have this outlier trades, and you got four systems, let's say, and the difference in profit on those four pieces of this big outlier could be very different. It's all guesswork. At the end of the day, each system makes about the same amount of money overall, but of course, you could make 400 ATRs in Tesla with a shorter term system than 250 ATRs you may have made with the longer term system. So, but it is good to diversify the outliers more. So it is less painful. So you may have the same 100 ATR drawdown in an outlier, but if you have more markets and 5% of those markets are going to give you an outlier per year, then being able to diversify. So maybe you don't get such a large drawdown in each one of your now more outliers. So that can really be very helpful in your sanity. So, when you lose 50 or 100 ATRs in an open trade, the percentage loss can be a lot less. It's still painful. I mean, I want to make as much as possible theoretically, but practically, I guess you always have to revert back to the money part of it. And trading these small, so many markets so small, it's an accumulation of a lot of your 5% of your outliers that's going to make it. And in what you said, Rich, made me reminded me of a discussion you and Niels had, where Niels was thinking that these drawdowns can really impact CAGR because they're losing trades and they're impacting your trade level. And notwithstanding the fact that we don't allow open trades to impact our trade level, but still your response was like one of the best of all time, which is the outliers dominate that trade level, and they more than make up for the drawdowns or the losing trades. And that's what's going to drive this CAGR, is the unlimited, uncapped upside potential.
Thanks, Jerry.
Okay, I think I'm going to go out and hit the beach and get some ice cold water. I've been doing way too much talking. So I'll give, though, a couple minutes for anybody who wants to make some final comments or who wants to ask a question. If not, if I don't hear anything, then I'm going to say goodbye and we'll pick it up next week. And we did record, so all is well for the weekend. We got our recording.
Okay, I'm also going to a very nice beach in maybe a few minutes, maybe 10 minutes. I will be swimming in the sea, diving, maybe even diving.
I hope one day we can all hang out together. How much fun would it be to hang out in Russia with Oleg? No secret, I'm already planning my 2023 trip to Australia. And then, of course, anytime anybody's in New York City, we need to hang out and see each other face to face over some wine or beers. So anyways, with that being said, I hope everybody has a good weekend. Thanks for being here. Send me some direct messages if you have some suggestions or complaints, questions, comments. And it's been fun, and we'll do it again next Friday. Thank you to everyone.
Thanks, everyone.
Thanks, everyone.
Bye.
Thank you.
Bye.
Thank you very much. Goodbye. Very happy moments you gave me. Thank you very much.